Hello and welcome to this webinar. My name is Antipas Asfor and I'm part of the team managing and monitoring investor accounts here at FxPro. This webinar is aimed at those who are not really familiar with Japanese candlesticks and their analysis. Candlestick analysis may sound like something advanced for many of you. What I want to show you, however, over the next 30 or so minutes is that this is not the case. Not only are candlesticks straightforward to grasp, they can provide the trader with early entry and exit signals that can significantly improve your trading results. Now, why do we care about improving your trading results? Well, unlike the vast majority of online forex companies, we are not a market maker. We operate an agency model, and hence we do not profit from your forex losses. Therefore, we are incentivized to help you by building the tools and training you to enable you to become serious and successful traders. Before we begin, please take a note of the disclaimer. What it essentially says is that what we will discuss in this webinar should not be seen as investment advice. So I'm not telling you whether or not to buy or sell any currencies or securities. The reason why we're holding these webinars is for you to learn through our interaction, so please make sure you get involved. During the event, if you have a question, please ask in the Q&A window. During the webinar, please keep your questions related to the content I've presented so that we can maintain the flow and keep on topic. I will stop at various points along the way and address any questions, giving you also the chance to ask any final questions at the end. All questions posted in the Q&A will only be seen by me. This webinar is being recorded, but please note that I won't refer to anyone by name and I will answer all of your questions anonymously. So let's get started. In this webinar, you'll be introduced to Japanese candlesticks. You'll recognize the advantages of using the candlestick approach, becoming familiar with single candle patterns such as the doji, the hammer, the shooting star, and you also learn how to interpret different candlestick patterns such as morning stars, tweezers, engulfing patterns, etc. So we'll look at patterns that are made up of a single candlestick and also patterns that are made up of multiple candlesticks. Most of you, I'm sure, know what the candlestick denotes, but let's just go over the basics to ensure everyone's on the same page. Well, candlesticks are similar to bars displayed on your MT4, for instance, in that they show the open, the close, the high, and the low. So this is a bullish candle, this is the high, the price reached in that particular time period, which each candlestick denotes, the close, the open, so price increased, moved upwards, and we also see the low displayed by the wick. The wick or the shadow indicate the extremes of the trading range, so the high and the low. And the real body shows the more concrete change in price from open to close. If price closes higher than the open, we have a white body, and if price closes lower, we have a black body. Now that we've gone over the characteristics of a candlestick, you're probably wondering what is so special about candlesticks. Well, for starters, although candlesticks are similar to bars on the chart, candlesticks are visually superior as it is easier to identify trends. So we can see here, quite easily there's a bunch of white candles, and this shows us the uptrend, and it's probably even easier to see this downtrend here with the black candles piling one after the other. Additionally, candlesticks can be used to complement other types of analyses like charting analyses and technical analysis based on indicators. The more forms of analyses confirm particular trade, the greater the confidence in that trade. So that's very important to note. Don't just look at a single candle and say, okay, I saw that candle, so I'll make a trade based on that candle. If you've got other confirmatory evidence that support that view, then it's a greater likelihood that the trade that you wish to go with may end up being successful. So if you've got a particular FIBO level or particular resistance level, and it happens that you also see some candlestick that shows some uncertainty with regards to price, some buyer and seller conflict, then in that case it may actually be the case that that resistance will hold. Now, the most renowned candlesticks are probably the ones that exhibit this indecision amongst buyers and sellers, such as the doji candlesticks. The doji candlesticks are special cases where the open and the close price are identical or almost identical. The lack of real bodies shows that market momentum is decreasing, causing a likely change in trend. And this change may not necessarily be a complete reversal, where price moves the opposite way. It may be just a change from a trending market to a non-trending sideways market. So we've got here the doji where the open and the close is more or less the same, the spinning top where you've got a small difference, and the long leg doji, which is similar to the doji, but the difference is you've got a very large wick. What's important to note with these candlesticks is that they need to have significant wicks, okay, and the wick relative to the body needs to be much larger. And the other thing to note is that just because there's a doji formed, it doesn't mean that there's definitely some sort of indecision in the market. You need to place it into context. It's likely that overnight during the Asian session you'll see multiple dojis on a 1 hour chart, because there's not that much movement, so price may close more or less where it opened on a particular candle. So placing it into context is very important. Now let's see these visually. Visually on the left we can see a doji at the top over here, which signaled a possible change in trend. What followed was complete reversal. We see here after which the price found resistance at the doji's high. So we see here that thereafter, following the rebound, the doji high more or less acted as a resistance. The spinning top now, which we said is a doji with a small real body, signaled the dying out of momentum after the strong bullish candles seen over here. So both spinning top and dojis, they signal a possible change in trend. So you may want to decrease your exposures, take profits, and maybe open new trades if price exceeds those levels. It just alerts you of a possible change in trend. But as I said, a possible change in trend doesn't mean price will simply move the other way. It may just mean that the previous trend, which was the uptrend, is coming to a pause, a hold, for some time, possible some consolidation or something. Now the hammer is another major candle, and it is actually one of the most reliable ones. Hammers occur at market bottoms and are a bullish sign. So we see here this hammer candlestick, the black candlestick here. They have small real bodies, white or black, at the top of the candle's range. So we see here the wick quite large, and at the top of the range there's the real body, with little or no upper shadow and a long lower wick. So we see here that price didn't move significantly higher from the open. There's hardly any wick, but there's a large wick on the downside. In order for the candle to be characterized as a hammer, the lower shadow should be at least twice the height of the real body. So that's an important thing to note, that you know, the height of the body should be, you know, half the height of the wick. So the wick needs to be significantly larger than your body over here. Now the opposite of a hammer is a hanging man, which occurs at market tops. Again, we have a small real body that can be white or black. That's not that significant. This body is seen at the top of the candle's range. So we see the white candlestick here at the top of the candle's range, with little or no upper shadow and a long lower wick. So again, you know, the shadow isn't that big on the top, and the wick is significantly large. Just like with the hammer, the lower shadow should be at least twice the size of the real body. Now we've got the inverted hammer, which is a bullish sign at market bottoms. So it's basically the hammer the other way around. And again, they tend to have small real bodies, white or black, at the bottom of the candle's range, with little or no lower shadow and a long upper shadow. And yet again, the upper shadow should be greater than twice the height of the real body in order for it to, you know, to be regarded as an inverted hammer. Now, shooting stars are the opposite of the inverted hammer, so we more or less have similar patterns. It's just that it's whether the long side of the wick is facing up or down, and whether it's at the top or at the bottom of a trend. And shooting stars, they show a bearish sign at market tops. You know, what they show us is that the longs, who were previously dominating the market, as we can see here, you know, started somewhat dying out, and the bears started taking some control. So the highs, the new highs, basically were not confirmed. And yet again, here we've got a small real body at the bottom of the candle's range, with a large wick, you know, on the upside, which showed that there was significant price action at the top, but at the end of the day, it was the bears that prevailed, and hence we see shooting stars at the top. Now that we've covered the single candlestick patterns, let's move on to some candlestick patterns formed by multiple candles. We've got here the tweezers bottom, and they show minor reversal signals, and they're made up of two consecutive candles. So we've got here these two candles that test the same highs or lows. So if they test the same lows, obviously they're considered tweezers bottom, and they indicate, you know, some support or resistance level. So okay, obviously, you know, here you can see that you had already some support from the wicks over here, but this just adds to the confirmation that, you know, there's support over here. So you may have seen the wicks, you may have identified this level as a possible support level, this area here, and the fact that you had the tweezers as well, you know, may give some sort of confirmation, added confirmation of a possible support level there. And you know, thereafter, if you've got maybe some other technicals supporting the view, you know, you could have charting analysis. If you were to draw some trend line, you know, you could possibly have a trend line here, and you would see a possible break of the trend line. You know, you've identified support, and then you've identified a possible break of the trend line, and you know, one thing supports the view of the other, and you know, it forms a more holistic and more concrete conclusion as to where you see things going. Now, the bearish and bullish engulfing pattern is another notable double candlestick reversal. The bearish engulfing is made up of a large black real body that completely covers the white real body during an uptrend, and the bullish engulfing, which is what we have here, shows a long white candle. So you see this one here, the body actually covering the body of the previous black candlestick, and this shows a reversal and then end to this downtrend, and thereafter a move upwards. These candlestick patterns are somewhat rare in Forex. You'd have to look at possibly weekly charts to see gaps like these form. See a gap and thereafter a close above the previous one that would give you some confirmation of a bullish engulfing pattern. Now we've got the morning star, which is the bullish reversal pattern, and it's made up of a large black candle within a clear downtrend. So it's important that you have consecutive candles moving lower, or if not consecutive, just a clear downtrend, followed by a small body candle, which can be either black or white. The final candle now is a large white candle that closes well into the first candle's body. Okay, so we can see here we've got a down move. Thereafter we've got a small candle which closes below the previous one, and thereafter you've got a strong bullish candle which signals the change in trend. And you need to have all three, and when it comes to possibly trading such patterns, you need to see the pattern complete. Just because you had the first two candles, don't assume that the next candle will be this, and make a trade based on anticipation of what the pattern will be in the future. Now the evening star is the opposite of the morning star. It's a bearish reversal pattern. The large white bodied candle within a clear uptrend is followed by a small bodied candle, a much smaller candle, that closes above the first one, and the third large candle is a significant move that closes well into the first candle's body. You'd want it to close at least below halfway of the previous candle, and this signals an end to the uptrend and move towards a downtrend. Now, one of the rarest reversal signals is an abandoned baby, which is comprised of a doji star that fully gaps. This is the doji star, which we said has more or less the same open and close, that fully gaps away from the previous and subsequent candle. The difference between the abandoned baby formation and the morning and evening star formations we just covered is that the central candlestick is a doji that fully gaps from the other two candlesticks, including the shadows. So you can see that not even the shadows are touching. So it's like an island, basically, a gap that basically forms an island. As you can imagine, in Forex this would be a rare phenomenon. You'd need to have two gaps, but they can happen, in weekly charts, if you do have the Monday opening gaps. Now, by now you should know the benefits of using candlestick analysis, complementing other forms of analyses. Be familiarized with various candlestick patterns, being able to identify them on your MT4 platform, and you should also be able to recognize indecision and reversal candlesticks. We said indecision candlesticks are ones like the doji, the spinning top, long leg doji, and using the candlestick analysis in order for you to adjust entry and exit points. I'd like you to come up with further questions as we're heading towards the final part of the webinar. I'd like to move on to an MT4 platform where we can see some things. Okay, so when it comes to doing the analysis, it's important to complement the analysis with other things. We saw in some of the examples that you could possibly do some charting analysis on some on some currency pairs, and complement that with the candlestick analysis. So here we've got a doji candlestick. As you can see here, actually it's a hammer. The market hammered down following the downtrend, and if you were to do some short-term trend line, you may identify a possible downtrend here. Let's see how significant it is. Okay, it's around 90 pips, and this level here would signal some support. You already had a spike, another hammer candlestick over here. This one's a more significant candlestick with a very large wick, and you also have some trend line which you can break, and confirmation of the breaking of the trend line, together with some identification of a possible change in trend from the candlestick here, may give you a greater belief of an upswing taking place. So it's important to complement whatever you do with candlestick analysis, because candlestick analysis gives earlier warning signals. Because they just single or two or three candlestick patterns, they take much they complete in they complete much faster than other charting patterns, and that's what differentiates them and gives them great value. But as I've mentioned a few times already, don't just base your trades on candlestick patterns. Use them to give you some confirmatory evidence of a change. If you've got some resistance level, for instance, and you see some indecision candlestick forming there, then that shows that it's likely that that resistance level will hold. So we've got here, here we've got a number of doji candlesticks. Okay, I guess some of them are probably during the Asian session. That's something you need to factor in, but some other ones may be in more significant times. And what we see here is over around this level, there was a lot of price indecision, and that price indecision may actually signal a possible significant level that may be a support or resistance. And moving on, we can see a break of that level triggered a breakdown and resistance thereafter. So they do have value when analyzed. Okay, now some of the questions are whether or not we can use candlesticks in shorter time frames. Yes, you can, but obviously the greater the time frame you're using, the greater the significance and the greater the move. When you're looking at a smaller candlestick, then the ensuing move will likely be much smaller. What is best to do though is to confirm candlesticks across different time frames. And what I mean by that is, if you've got some particular hammer, some particular candlestick forming, let's say a hammer during a downtrend. We said a hammer looks like a hammer basically. It's this one here. Let me just zoom in. Yeah, so a hammer candlestick, looks something like this, but it needs to be following a steep down move. So this one here, yeah, you know, you see a hammer candlestick and you see on 15 minutes or in 5 minutes, you may want to switch to some greater time frame and see, you know, whether you've got some confirming evidence from the other time frames. Because you're looking at 15 minute, you know, some other trader may be looking at 30 minute, 1 hour, and you know, at the end of the day, you're all seeing something different. So if there's something that everyone is seeing, it's likely that it's a more significant event. Okay, about engulfing inside bars. Basically, inside bars are somewhat rare in Forex. You'd have to move towards, you know, daily candlesticks and see Monday gaps in order for you to identify such bars. You know, we covered the engulfing patterns for those cases. Which bar is the most significant? Which candlestick is the most significant is another question. When it comes to single candlesticks, I'd say the hammer candlestick has the greatest validity in identifying a support and a likely change in trend. The other single candlesticks, you know, they require more confirmation in order for you to possibly trade on them. Okay, what is more important, a long leg doji or a doji? A long leg doji just shows greater price action, and much greater indecision, because it shows you that there was a lot of activity, price action taking place in both sides. You had both the longs and the shorts fighting to take command of the market, and that shows you, you know, a particular level where the doji open close takes place, that you know, things settled. If you are to analyze dojis, probably the daily charts would be better than shorter time frame charts. But again, you know, bear in mind, dojis to show some indecision. They don't necessarily show a reversal. So, you know, we're looking here at euro dollar, and you know, there may be some periods over here, for instance, where you had, you know, doji candlesticks forming, consolidation taking place, but this didn't mean that, you know, the market moved the other way. It just meant that, you know, things cooled down before the continuation of the downtrend continued. Another question is how can they be used for entry and stop losses when encountering major resistance or support levels? You've identified, let's say, a resistance. So we've got one here, just for the sake of an example. So we've identified one possible resistance here using, you know, some dojis that show some indecision, some lows, etc. What you may want to do once you've identified this is see what candlesticks appear at those levels. So okay, we're on the 1 hour, we see that there was a breakdown, possibly some, let's just figure out what it was. Okay, it was during the FOMC. So it was during the FOMC, and what we see here, let's say, you know, we saw this downtrend and break of the resistance. support, sorry, and market was moving higher, and we're in the 15-minute chart, and we've identified around about this level as some resistance area. Now over here we see some significant price action taking place, price closing there. A second candlestick here shows yet again resistance. Over here short-term candlestick shows things bottoming out over here, with the doji candlestick that you see indicating yet again indecision at these levels. The significance of looking at smaller candlesticks is that you can sooner identify whether or not that level will indeed act as your support or resistance. Because if you're looking at, you can even go down to 1-minute charts and see whether your support or resistance will hold. Obviously, the 1-minute chart, things are very volatile, and you can't really rely on those. But you may want to see whether or not there is a breakout. So you may switch to that one and see whether that level is actually being tested as resistance. Is price retracing at that particular level or not? And when it comes to placing stop losses and entries, when it comes to stop losses, okay, you've identified your resistance here, you're about to go short. Let's say you have a doji, or you have some candlestick, a long leg doji, you may want to place your stop loss just a bit beyond the extreme of the wick, simply because you've had price action over at that range, and it may help you in that sense. And again, for entry, you may use the candlestick as a confirmation that indeed there is some resistance at that level. So I'll close my long, or I will go short once I have a candlestick that shows me a reversal. I see a hanging man at the top, or a hammer at the bottom. These sort of things. Okay, I'm being asked about the moving average that's here. This is just the default moving average of the chart. It's no particular one. This is just for illustration purposes, so nothing special. Sorry about that. Okay, if you've got any further questions, keep them coming as I go through some final slides. Okay, now your next steps. Now that you've embarked on this journey to candlestick analysis, it's important to get further involved. Experience is the best tutor, so you may want to download our MT4 platform and run a demo account, putting into practice the various analytical techniques we discussed. You can learn more by accessing our tools and news section on our website under the FxPro Trading Academy, and you can sign up for our next webinars from our front page. Let me just show you some of these things. Okay, so we've got homepage here, tools and news, and you can access the Trading Academy to learn more about trading, and the glossary, the articles, the videos. We also have the webinars page. If you don't know how to get here, just go to tools and news, FxPro webinars. The next webinar is the coming Monday on the outlook for FX fundamentals with Simon. And if you want to watch past webinars, you can just click here. There'll be a recording of this webinar real soon, and this is the watch and learn section. But more importantly, you can go to the FxPro YouTube channel and see all our webinars there, and you can find the one that interests you to watch over and over again to get a better understanding of the concepts we've covered. Okay, then some final questions now. Okay, question is whether there are false breaks during the testing of the resistance level in smaller time frames. It depends, how much space you give for a confirmation of a breakout. I don't know if you attended our previous webinar on charting analysis, but what we mentioned there and what you can find on the on our YouTube channel, in case you've missed that one, is that fake outs do occur. You do have whipsaws, a possible break of a resistance that actually didn't take place. Using smaller candlesticks does have, when I say smaller candlesticks, I mean smaller time frames, does have a risk that you may be too early in your action, but that's the reason why you need some other confirmation evidence. If you've got some resistance level there because of some charting analysis, or RSI's at extreme overbought levels, then that may add up as an argument that resistance is inherent at that level, and thereafter, it goes down to you and how patient you are to see a confirmation using some candlestick analysis. Probably the indecision candlestick may not be ideal because it simply shows indecision, and it's possible that price may consolidate at that level. Reversal candlesticks are possibly better suited for these cases, and they also reduce the likelihood of a whipsaw. About how can one make sure about finding entry and exit points, and whether or not resistance will hold. The thing is, if resistance breaks, it becomes a breakout and it forms into a support. So you need to set your exit levels at quite fairly close, but not too close to the resistance level, so that you basically close that position. You may even decide, if that's truly resistance, to go the other way. You were initially going short, but because the resistance broke, you go long. So that's a possible alternative for you. But you can never be sure about looking at a chart, looking at particular candlesticks, and deciding whether or not the resistance will truly hold. Okay, I think that covers it. If you get stuck on anything, please email us at support@fxpro.com, or contact us by live chat. We'd be more than happy to hear any webinar ideas you may have at webinar@fxpro.com. A final question is, what would be considered a good breathing space for a stop loss? Okay, it depends on your risk appetite. If you're risk seeking, then it's likely that you may place a bigger breathing space, especially if your profit target is quite significant. But if you're going for 10 pips, putting a 30 pip breathing space for a stop loss doesn't give you the best risk reward ratio. So it's important about where you want to go. And the other thing you need to note is the breathing space is not constant. It doesn't mean okay, I give a 10 pip breathing space, I'll always give a 10 pip breathing space. You want to identify a level that has some significant resistance, let's say, if you're about to go short or long following the break of that resistance, but in this case go short. And you need to see whether or not price moving certain amount of pips above that would confirm a break of that resistance. And that could mean looking at previous candlesticks. Was there a hammer candlestick in the past at that level? Was there a doji candlestick? And did we break that level? So it always helps moving back and seeing the price action that took place at that level, and basing your decisions on those in order to determine the significance of a particular level and how much breathing space should go for that particular trade. Thank you all for watching. I'm Antipas Asfor, Portfolio Management Officer here at FxPro. Thank you.